So guys, I'm going to go ahead and go through some of the tax strategies for real estate investors. First, I have to say, and I'll probably have to say this about 55 times because you guys are probably going to have some very detailed tax and legal questions for me. But I am not an accountant, a CPA, a financial planner. I'm not an attorney. But I'm going to share some of these things with you that have been and have worked for me and have worked for my husband over the 15 years we've been investing in real estate. And I will say, guys, have your personal plan. Check with someone else who is an attorney, a CPA, a financial planner. Yes? Yes or yes? Yes? And I will tell you guys that over the years, our plan has changed as well as the market has changed, as different rules and laws have changed. That has affected what we've done too. In some cases, I'll go back in the time machine to show you what we have done and what we do now as well. Some of the discussion points for tonight, I'll go through the Homestead Exemption. Does everyone in here know that you guys can take up to $250,000 to $500,000 tax-free to your bottom line if you sell a house that was your homestead? Some of you guys know that, maybe not all of you. I'll go through where you can get some information on that as well. Income taxes versus capital gains taxes. I'll give you some great examples on that and what that looks like in terms of putting the numbers together. Being able to take depreciation on rental property, entity formation. How many of you guys are thinking, well, what entity should I set up? I don't know yet. I want to get started. None of you. Great. So this is really going to apply. This is fantastic. I'm so glad you guys are so engaged tonight. Fantastic. I will also talk about 1031 exchanges, and I got a couple more in my notes on my phone too, that if we have time, I'll talk to you guys about as well. One of my favorite ones, and there are very few gifts that the IRS tax code gives to us in life or as real estate investors. And as real estate investors, this is definitely something that we can take incredible advantage of, which is this. If you sell your primary residence that you have lived in the last of the last 5 years, and if you have not sold another primary residence in the last 2 years, and a single individual can take up to $250,000 tax-free, and a married couple can take up to $500,000 tax-free. And I know what you're thinking. Let's get married tonight. So $250,000 to $500,000 after 2 years is usually not a likely scenario in Austin, right? But it is a likely scenario if you've owned this property for maybe 10 or 15 years, specifically in the Austin market. And it is definitely a likely scenario if you're investing in places like California, right? So sometimes people have the problem, and I usually don't bring it up here, but sometimes people have the problem of, well, what do I do if I'm making more than $250,000 as a single? What do you do? Then you can, somebody said in the back. Who said that? Yes, you can do a 1031 exchange on it. Yeah, perfect. So we'll talk about that as a strategy as well. So you'll see some people who will turn it into, or just not sell it as a homestead, instead sell it as a 1031 exchange, and therefore defer all of those profits into the next property or let their kids take care of it, which is a cool problem to have as a young one. Some more information about the Homestead Exemption. You have to meet their ownership test. A lot of people will, in fact, one of my colleagues who's also a real estate investor, he's been using he lives half time in Houston, half time in Dallas. He uses his Houston property as a short-term rental. And he's very clever about it. He's about to move back into it, and he has not sold another homestead in the last 2 years. So, and he has been on his tax return using that as his primary residence. So he's going to use this primary use rule and absolutely max it out to be able to sell it to get the homestead exemption, even though he hasn't actually lived there the entire time. It was his primary residence. Let's see, the ownership test, we just talked about that. And generally, you're not eligible for the exclusion if you've sold another homestead in the last 2 years. So you have to wait to do it every 2 years. For us as real estate investors, you should think of your job as, I want to move into a different property every 2 years because I want to get $250,000 to the bottom line every 2 years. As a single individual, that's effectively like you making $125,000 a year. but it's not $125,000 gross, what we think of when we're working for somebody else. It's more like $200,000 gross that you get to take $125,000 to the bottom line. So as a real estate investor, you should think my job is just to move into great properties, fix them up and resell them, get a great discount on them and resell them again every 2 years. If you'd like more information about that, you can either Google the Taxpayer Relief Act of 1997. It can be found in the IRS circular. I think it's called the 701. So if you just Google that Homestead Exemption Act or the Taxpayer Relief Act, they'll go through a lot of different things to give you a lot more detail on that. I have seen some exceptions where someone has gotten divorced after they've owned a property, for example, for 18 months, which has given them ability to take a portion of those increases tax-free. They do have some special circumstances specifically for people who are in the military as well, to be able to take those gains tax-free as well. So that's one thing that I want to share with you too. It's not exactly set in stone. It's mostly set in stone, but there are a couple little exceptions. Income versus capital gains. So I have, I don't know if I've mentioned this to you guys before, but my mom is also a real estate investor. In fact, my mom and my stepdad actually still have 12 different properties to this day. And they'll also do occasionally some buying, fixing, and flipping. And she had one property that she had held on to for a long time, and she had gone under contract like in month 10. And it was supposed to close, for example, let's say she bought it on January 1st. She had gone under contract in October, and it was supposed to close on December the 15th. And she was looking at, when she bought it, she said, oh my gosh, I'm going to make about $70,000 on this thing. I don't want to pay income taxes at my income tax rate. I want to pay the capital gains tax rate. So she actually pushed the closing out 2 weeks so it would be taxed at that capital gains tax rate. And I'll go through some examples of what that looks like financially as well. You have to hold the property for a year. Obviously, for most of us as real estate investors, we want to get in and out of that property in about 6 to 7 months. That's very typical for a buy, fix, and flip. But if it's something that's a little bit more complex, specifically in this particular case, she had moved a house onto a property. So there are some special considerations when you're doing stuff like that take a little bit longer that she had budgeted in. But it was just the timing that she was able to really get a nice gain from and save about half in taxes. You do need to keep a good record of the improvements that you've made on that property. Otherwise, you're going to be paying taxes on the improvements you've made. If you have that record, then you get to write that off as well, which is really smart. As a quick example of what this looks like, so let's say that you bought a property, for example, a year ago, you paid $200,000 for it, you sold it a year later for $300,000. Let's say you are a person who earns $140,000 a year in your regular W-2 job. Let's say you're filing single, for example. Using the 2018 federal income tax bracket for that $140,000 for a single individual, it's 24%. So in that case, if they held it for less than a year, they would be taxed at 24%. But if they hold it for more than a year, they get taxed at 15%, which is a nice break, especially if you're really close to that line. Let's see what else I want to say here. More details on that. You guys can go to Anderson Advisors. They're a national company, but they do a lot of work for real estate investors as well. Or you can just Google the term income tax rate versus the capital gains tax rate. Guys, is there anyone in here who still has a buzzer? Is anybody in here still has a buzzer? If there's if you still have a buzzer and or if you don't have a buzzer but you'd like to join membership with us tonight, if you will, just stand up, and Graham's in the back and he's going to wave like this. So Graham will help you guys with membership. He just gave me the signal that they're closing the membership table. So again, you get a blueprint, you get a ticket to our 3-day training, and you get to come to our monthly meetings as well as our listserv as well. So again, just Google the term income tax versus capital gains tax rate. It really becomes important when you're holding a property and you're just kind of on that edge. Or for us, for example, we hold a lot of rental properties, so all the rental properties that we hold for longer than a year, we always get the capital gains tax rate on that. Now, there is something a little tricky here. Has anybody read, or is anybody afraid of something that's called the dealer status? Dealer status? Anybody? No one's? You guys? Okay, a couple of you guys. Okay. So some people are worried. Well, at what point do I become a real estate dealer from an IRS standpoint? The IRS in their code about being a real estate dealer have not put in the exact number of houses that you have to buy and sell, for example, to qualify for that status. But the big fear that people have is once you get classified as a real estate dealer, then at that point you can no longer take what? Capital gains. Okay. Capital gains. Now all of the money that you're getting, you're paying income taxes on, right? So a lot of people don't like that. So for us, one of the ways that we've tried to solve that problem personally is that we have entities that are our buy and hold entities, and then we have entities that are our fix and flip entities. So if one of our fix and flip entities, for example, were ever to be called a dealer or get that dealer status, that would not affect our other entities that are in the business of long-term buying and holding. So for us, we have, and I'm not trying to brag, but we have a 100+ page tax return because we have all of these different entities in place that hold all of our properties because we don't want that dealer status. So there are some certain things that you do from an entity planning standpoint to make sure that that you get to keep that, preserve that right to be able to do that, because it is very nice to be able to do that. Depreciation. Depreciation is one of the things that we get to write off as part of owning rental property. So when you guys do, for those of you who own rental property, you have a Schedule E on your tax return, so you might have your 1040. If you have, for example, an LLC, you'll probably have a Schedule C tax return as well, and if you have rental properties, you'll probably have a Schedule E. Remember, I'm not an attorney, CPA, or financial planner. I just reviewed my own taxes, okay? But one of the things that we write off on our rental properties every year is depreciation. There are a list of other things that you get to write off here as well. But depreciation is going to be the one that we focus on as we go through this presentation. So one of the things that you'll learn when you have rental property and you're trying to get to depreciate it, and I say you get to depreciate it, you only get to depreciate the improvement. You only get to depreciate the structure. You do not depreciate the land because in general, land appreciates, right? So you and your accountant will decide if you buy a house, for example, for $300,000, you're going to say, well, how much do I get? What's the percent that I get to depreciate? You and your accountant need to come up with what that initial value of that structure is versus what that initial value of that land is based on that purchase price. Now the county, they divide that value up between the land value and the improvement value. So that's always a good starting place. Some of you guys might be able to make an argument to change that, but that's always a good starting place, and usually what's commonly used for that determination. Now, depreciation is an expense you get to take on paper, but it's not an expense that you actually have to pay out to someone. So we call it a non-cash expense. So the benefit of that is you might have a rental property that is making, let's say, $3,000 a year in cash flow. Well, you may be depreciating, for example, $500, $800 a year for that structure, for that improvement. And if that's the case, that's $800, for example, that you get to write off as if it were an expense to you. So it makes it look like you are making less money, which makes you get taxed at a lower, or you pay less in taxes on that rental income that you're getting. There is, however, you do have to do a depreciation recapture at the time that you sell that property. So, but don't worry, you're not going to have to pay back, if you will, the entire 100%. You only do the depreciation recapture at 25% of the depreciation that you deducted while you own that property. So it still is very much a benefit to you, even though for most of us, especially those of us investing here in Austin, those values are going up. If you want more information about depreciation, again, Anderson Advisors has some great stories about rental property tax deductions, or again, just Google depreciation for rental property. I don't recommend that if you guys are investing in real estate, I don't recommend that any of you guys do your own tax returns. Just don't do it. The depreciation schedule alone might just kind of throw you off. Bring it to a real estate friendly CPA, real estate friendly accountant to be able to put this in order for you. Phil and I don't do our own we don't do our own income tax return. We never have. We've always brought someone on who can also, the benefit of doing it, it's great to do it yourself. If all you do is work a W-2 job, right? Then yes, go and do that yourself. But once you start investing in rental properties, once you hold properties over that December 31st line, and you've got to come up with that cost basis and go through depreciation schedules, at that point you probably want to hand it off to someone who this is what they do professionally. In addition to that, they can tell you, oh, well, you should do this, that, or the other because you will save in taxes, right? So usually their advice is worth the amount that you pay them. So my very strong advice is to pay them. For those of you guys who are looking at entity formations, so I say follow the laws and the taxation changes. So when we first started investing in 2003, because of the way that the taxes were set up, specifically state taxes, limited partnerships or LPs were the ideal entity type here in Texas. Now, entities setting up an LP was more expensive for us than setting up a basic LLC, and it was the right move for us to go up until about 2007. After 2007, limited partnerships became subject to the Texas franchise tax, which is more than a little confusing if you are investing in real estate, because it's not super clear in terms of, are we taxing you on the sale amount of that property without respect to how much you bought that property for, how much you invested in that property for? So there's a little bit of that scared the heck out of all the real estate investors who had an LP to invest in back in 2007. And then around 2007, a lot of real estate investors moved strictly to an LLC. All right, so come 2009, series LLCs were introduced in Texas, and they're very much like a traditional LLC, and is governed by the business code here in Texas that was again modified to include it back in 2009. They were using it, I believe, in like Delaware or Denver before this, but it just became approved in Texas in 2009. This is basically where you can set up one LLC and have different series underneath it, where you can put individual properties in each of these individual series and still get the same asset protection, for example, that you would if you had every property in an individual LLC. Unfortunately, when we first started investing, this was not a thing, right? And still there's a little bit of murkiness around this that confuses a lot of people, including banks, including title companies. We'll kind of walk through what that looks like. But I will say, this past year, what do? There was a new tax code. And one of the things about the new tax code, and a lot of real estate investors are now looking at, instead of doing an LLC, a lot of investors are now looking at doing a C Corp for their investors and for their investing. Now, I'm not suggesting you go with any of these. Again, I'm suggesting that you have a very long conversation with someone who is more skilled than me, who can advise you based on your particular situation, because all of us have very different situations that they need to look out for. Going into a little bit of detail on the Series LLC, which is still a current darling for real estate investors. Each series is insulated from the other series, as well as from assets and liabilities held by the company at large. In fact, some people, I've seen some attorneys suggest that you get kind of I'm sorry, I'm going to not use the correct word, but a company over your series that your series LLC rolls up into, that maybe has a 1% ownership, for example, and that's actually how we set up for our LP when we first started investing. But what's good about having the series LLC is that you're not paying an attorney to draw your LLC documents every time that you are buying a new property and want to put your property in that new LLC. The other benefit is you're not paying the state filing fee, which is about $300, and which gets expensive again as you own a lot of property. All of this just starts to add up. Record keeping. So a lot of people were worried about record keeping. For us, we use QuickBooks and we use different asset classes for each of our different rental properties. So that way we can use, even though we have multiple LLCs, we use one bank account for those. But because of our accounting is very differentiated between the individual companies, there is case law or attorneys that say that using one bank account between your rental properties or between your series LLC should be enough, as long as you are coding or classifying those individually and not mixing funds in between them. So for us, we have several different companies. When we first started investing, I would just move money from one company to another and just kind of go on with my life. And our accountant was like, nope, you can't do that. You have to do it like this. You have to take an owner draw from company number one, and you have to do an owner contribution to company number two. And I'm like, but that's 2 steps. Like, why can't I just, it's the same thing. And they're like, no, you can't do that. So this is, again, to protect you guys and show you the right way to be able to, so someone doesn't come in and what they call pierce the veil. When they talk about piercing the veil, they basically are saying, well, I know you think you have an LLC, but because you did all these weird intercompany transfers, because you took all these personal expenses in that LLC, well, basically now we are allowed to pierce the veil of that LLC and go after you directly, which is something that a lot of real estate investors are very fearful about. This is one of the ways to make sure and do it right so that that veil does not get pierced. So they say it's not necessarily necessary to establish a new bank account for every series in your LLC, and I'll tell you that before some of this information was published, it was very unclear for real estate investors. Well, how do I do these series LLCs? How do I set up a new bank account? Because when you set up a new bank account, what does your bank want for an LLC? They want a new EIN number. And your series LLC doesn't get like multiple EIN numbers, so that like trips a bank up right from the start. So this is very helpful information for you guys as you're trying to set up different bank accounts. Again, I'm not an attorney, CPA, or financial planner, but a lot of attorneys are saying you don't need to. Now, the other way that people get tripped up when they use series LLCs, because even though this has been around for almost 10 years, for a lot of title companies, it's still new. For a lot of underwriters, it's still new. So sometimes title companies will throw a fit about these series LLCs because they don't understand them, and because they're the one who's insuring, and they want to make sure that they're insuring something that is safe for them and something that won't backfire on them. So one of the things that they require is that your LLC be in good standing. When you get a letter of good standing, and I don't even think they call it necessarily that anymore in the state of Texas, but it's effectively that. They're not going to give you a letter in good standing for each one of the series within your series LLC. They just give you a letter for one. So your title company is going to look at that and say, well, I see that Shinoa Grove buys houses, series LLC is in good standing, but I don't see that the series underneath that, maybe Zilker Grove, my son buys houses, LLC, is in good standing. Well, it's because it's not really an entity, or it's kind of like a disregarded entity, so of course I'm not going to get this. Well, then we can't insure this property because it's not in good, you can't prove that it's in good standing. So it kind of becomes a circular thing. So they have to, so there's another layer of information that you have to give them to share with them in order for them to be able to go through with the transaction. So some title companies will request a doing business as, or a DBA, for each one of the series, and they will require that that's filed with the county. Part of the purpose of doing a series LLC is what? Anonymity. Anonymity. So sometimes title companies, in order to allow you to sell a property, and he who has the gold, or he who can facilitate the transaction, can get in the way of you getting that anonymity that you were going after in the first place. So sometimes they'll require that you file a DBA for that. Some title companies will require a company resolution. Oh my gosh, I have gone around circles in title companies on some of these different things. Basically, what they want to make sure of is, can you, Brooke Campbell, sign for Brooke Campbell buys houses in Austin, Texas, LLC? We need a letter that proves that. So I've gotten emails like that or calls like that from title companies. It's like, well, duh. You know, I'm thinking like, this is my company. Well, no, you need to prove that this is your company. Okay, well, here's my tax return. Well, that doesn't prove it. Well, what do I need to prove it? Well, you need a letter that states that. Well, how do I get that? Well, we can write one for you for $250. I was literally, like, when I got that response, I was about to rip somebody's head off. And that's why I always close at the same title company, because they don't, like, throw up little things like that, which drive me crazy. So I instead asked her, well, can you give me a sample of what that might look like so I can go and copy it without paying you $250, unless you have a $250 email fee? Is that what's going to come next? So that's what I did. But it was really annoying to me to have to go through that process. But be aware that if you're closing in a series, and even in a regular LLC, because they've done it to me, they'll do it in both. Sometimes they'll require that, which is really like, oh man, I just want to punch somebody like in the neck. Like I don't know, like that just really annoyed me. Sometimes they'll demand a copy of the company agreement. This is another thing that we want to keep private. Especially if we have other people involved in terms of their initial owner contribution, in terms of their ownership, etc. Don't want to put that out in the public record. That's the whole reason we have an LLC. All right, C Corps. So again, this is for the new tax code. It permanently lowers the corporate tax rate from 35% to 21%. This is a huge deal. This is a huge deal, and this is why you see a lot of investors jumping from an LLC that's listed as an S Corp to now going over to C Corps. So in comparison, pass-through businesses, which an LLC is a pass-through business, so it passes through from your Schedule C, for example, if it's an LLC, to your, for example, 1040EZ tax return. They may only receive a 20% deduction on qualified business income for certain business types. And they say these pass-through businesses will only be able to claim this deduction for the next few years, whereas the 21% tax rate for C Corp is permanent until some other president repeals it or changes it or does something different. So in addition to this benefit, corporations no longer have to face the alternative minimum tax, which is a separate tax that they do some calculation on to basically have you pay more in taxes, and really scares people, freaks them out, and increases their tax bill. And there's almost always a comma when you qualify for the alternative minimum tax in terms of your bill. They say after the sunset of the 20% deduction for pass-through businesses, the value of the C Corp taxation will increase in comparison. But again, for our business in particular, after this came out, a lot of people were telling us, oh, well, you got to change all your businesses over to a C Corp. And so we went to our tax advisor and went over the tax return, and they're like, yes, you will save money today if you move over to a C Corp. But over the course of X many years, because of what we do as real estate investors, you will end up paying more by year 4 than what you are paying today if you make that switch over. And I'm like, well, wait a second, but all this stuff says you should do it. So again, don't just read some of the headlines. Your tax preparer should be able to prepare your tax return multiple ways and just see what that savings is for you as you go through. So have them do that as you get it set up. For more information specifically on series LLCs, I love LoneStarLandLaw.com. Texas-based. He's based in Houston. He's an attorney. He is like incredibly prolific. He's written a ton of articles about all different sorts of things that are legal, attorney, properties in Texas, and I've used him as a resource for a long time. That's for the legal piece. For the taxation piece, again, Anderson Advisors or your personal attorney, CPA, etc. Entity formation. So some people still say, well, I'm just going to set up just a simple LLC and I'm just going to get going and do this on my own. For those, we've seen people use inkfile.com. We've also seen people use bizfilings.com. So it's a $150 to $220 fee, plus you have to pay the state filing fee, which for an LLC here in Texas is about $300. Now, you do need to get something called Articles of Incorporation. So when you get on this site, you're going to have all these options like, well, do you want this? Well, do you want this? Well, do you want this? Well, and you're like, I don't even know what any of this stuff is, right? The big thing that you need to make sure you're getting are those Articles of Incorporation. The Articles of Incorporation will come up when you go to the title company because, again, they want to be able to prove that ownership piece. If you don't get them, that means you have to get them later, which is usually a big pain in the butt for most people. EIN numbers. There are a lot of companies out there that will charge you $100 to set up your EIN number. That's the one thing that I do every time because the EIN number form is a one-page form, very easy to get. You can do it online. You can have your EIN number instantaneously. Having that EIN number, that's what tells the government, hey, this is what kind of return I'm going to send, whether it's a Schedule C, or whatever it may be. And having that EIN number will help you as you get bank accounts, etc. So, and as you issue 1099s to the contractors that work for you, so you'll definitely need to get all of those things going as soon as you go through. 1031 exchange. So for those of you who don't want to pay any taxes at all today on property that you've owned for a long time, there's a way to defer those there's a way to defer those taxes. And I'm not saying not pay them, I'm saying defer them, so at some point that you will pay them. But what you can do is roll those gains that you got, or excuse me, not roll those gains, defer those property taxes, which allows you to invest more in another property. So, for example, if you were going to pay $50,000 in capital gains, right, because you pay taxes after you've owned it for a year, instead of paying that $50,000 today, you can defer them by selling that property and buying other properties, okay? So that tax gets deferred over. What that does for you, for example, is if you were going to pay $50,000 in taxes, now you've got $50,000 more with which you can buy a more expensive property. So it just gives you more money to invest today. Again, the tax is deferred, but it's not eliminated. There are a couple of rules for it. Properties must be like kind. So income, commercial, speculative raw land, or investment properties. People are worried, well, do I have to exchange a house for another house, or an apartment for another apartment, or land for land? No, it doesn't have to be at that level, but it does have to be kind of like an income-producing property. So you can go raw land to commercial, to apartment complex, to single family, go all that entire spectrum. Now, there are some very specific rules when it comes to doing a 1031 exchange. Number one, at the time that you sell your subject property, before that, you have to decide, am I going to do a 1031 exchange on this? Because you can't get written a check and then later say, I want to do a 1031 exchange on this. Because after you have that check in your hand, there's no rolling it backwards. You have to decide before you go in. You have 45 days after you sell your subject property to identify, for example, up to 3 more properties that you might purchase, okay? Then after that, you have 180 days to be able to close on those investments. If you do not identify those 3 properties in that 180 days, or if you do not close on one of those 3, if you do not identify one of those 3 properties in that 45-day period, or if you do not close on one of those 3 properties in that 180-day period, then now your exchange is disqualified, and now you're paying capital gains tax on it. The IRS says you must use a qualified intermediary. Again, this is not something that you're going to be doing yourself, and I'm going to give you the names of two qualified intermediaries, one that I'm very familiar with, one that I'm kind of not as familiar with, one that I've met before. Again, the seller is not allowed to have access to the proceeds. Your intermediary cannot be a family member, banker, lawyer, priest, etc., right? There's a form that you'll use, the IRS Form 8824. That's the like-kind determination. Again, your 1031 exchange intermediary will handle that for you. Some people ask, well, I'd like to take some money and spend it and use it for me. And I want to put some money into that deferred exchange that goes to buy that next property. You can do that, but you will pay taxes, capital gains taxes, on the part that you take today. You will defer the taxes on the part that you do not take today. So a lot of people will do 1031 exchanges, for example, if they have a property that they've owned for a long time, for example, in Austin, Texas, that has gone up in value substantially, is maybe now not cash flowing because property taxes have eaten up all of the increases in your cash flow. And maybe that property is now, you bought it at $200, maybe it's now worth $500 as an example. You can sell that $500,000 piece of property and double down and find two more $250,000 piece of property and do what? Watch those properties grow up in value too. And some people want to postpone their taxes until they're retired, when they're not earning maybe that $140,000 a year as an example in their W-2 job, when they're just maybe doing a lot less. Maybe they're on the beach, so because their income is lower, their tax rate is lower as well. Luann Blau, she's based out of Dallas, and most of the people you're going to find who do 1031 exchanges are not going to be based here in Austin, but Luann has helped a lot of my colleagues over the years. Wei Ya Lam also does them. I'm not as familiar with him. He has come to talk to the group before, but also someone who might be of interest too, as you just talk to different people. The fees are usually minor compared to the benefit that you get, but yes, you will pay a fee to your intermediary to go through this. Guys, any questions about anything we talked about tonight? Was this helpful or new? I hope in some ways. Okay, good. Again, I'm not an attorney, CPA, financial planner, but guys, thank you for joining us tonight, and we'll see you at the next meeting.